Good evening, everyone. And today we are talking about Module 5. Bear with me a bit. I have a bit of technical problem. My laptop doesn't want to use my Bluetooth somehow, so I have to use my wired mic. Hopefully, it's loud enough. I was trying to plug in my son's big what they call that, game mic, but I think it's a bit too tight. So we decided, no, I just start with this thing. So today we are going to talk about navigating financial market and human psychology. Because it's quite a lot of slides, so I'm just kind of making sure that I don't overrun and make sure that everyone has a chance to learn about it and also got a chance to have a bit of Q&A. Um, as we'll cover quite a bit of thing, I would like to start off with key concept, and then the key concept might be a bit dry, but definitely try to input some jazz into it as we go along. So if you have any question or any query, feel free to post on a chat. I should be able to see the chat. Yeah, I should be able to see the chat here. So without delay, let me start off with this Module 5, Navigating Financial Market and Human Psychology. I hope everyone can see the slide. Assume press 1. Should be okay, right? Darren says it's okay. Okay, next. Again, start with disclaimer. The information that I'm sharing here, of course, is from public sources, a lot of research, but of course, it's also expression of belief only. So we have not verified some of the information, and no representation or warranty on the information itself. Information is subjected to change too. So definitely, we cannot take the responsibility to maintain the information as timely as possible. Presentation intended for general circulation, so do not take into a specific investment objective. If you need any specific investment objective, you do seek advice with our financial advisor, respective person for your special need. Okay, so that's kind of quick disclaimer. So these are the topic that I will be covering. The content include because there's many slides. I think 1 to 4, 1 to 3 will be a bit dry, mainly on some of the concepts and also a bit on the key terms and condition or the definition. Then, of course, I hope to complete before within the first hour to finish until hopefully by topic 4, so that we give a bit more time at the end for Q&A. That's my intent. So first, we'll talk about type of financial market, size, and then a key player of the financial market, structure of financial market, and market cycle, and economic indicator that related to the cycle, understanding a bit of the risk and return on investment, and then of course common emotional bias and how to overcome them. So those are the key area that I will try to cover in today's 2 hours. So after 1 hour, probably by I think topic 3 or topic 4, we will take a break, 5 minutes break before coming back. So that's my plan now. As we move on, let's go on to the first slide. Let's see. So type of financial market. These are not exhaustive financial market I'm going to cover, but more the key financial market. There are many more. So don't expect me to cover some unique market like crypto and all things, because those are more new market that I will not cover in this area. First, let me start with stock market. Of course, most of us are very familiar with this, as you are one of those investors that is keen to learn about investment. That's why you join our training. Um, I believe many of them could be very active on investment, but I guess the definition of stock market uh, is a venue where company enabling the company to raise capital. So company listed in there to raise capital, and then we participate in it. Hopefully that the counter that we bought has capital appreciation, and the counter we buy also give us dividends. Okay, so example, Nasdaq was listed. Apple was listed in Nasdaq, and it raised a lot of capital, and that helps in a lot individual investor, institutional investor, and other players. But again, also people like BlackRock also has heavy influence on the stock market because they invest heavily on a different player in the market or different counter in the market. In fact, I a bit of delve into it. The top 3 or 4 company of this investor, institutional investor, BlackRock, Vanguard, First Street, and a couple of others actually own a huge amount of those big or most MNC, and they have influence on the market through their strong institutional participation. So key exchanges in all the stock market are NYSE, which you are very familiar, New York Stock Exchange, but they are more known for traditional stock. Okay, Nasdaq is known for tech giant, tech company like Apple, Amazon, Microsoft. They are more listed in this US stock exchange. Of course, beyond that there's also other stock exchange like London Stock Exchange. You have also other area in Germany, Italy, or even in Hong Kong, China, and everywhere. The market cycle of the stock market has always 4 phases. Later on, I will touch on it, but basically the accumulation phase, the uptrend phase, there may be distribution phase and other phases. 4 key phases we will talk on it. But there are key indicators in the market cycle. Mainly, you have they will look at economic indicator like GDP, growth, unemployment rate, interest rate, and inflation. Those are the things that we will look at to see how is it moving in the market. Okay. As I said, this feels like will be a little bit dry, but it's a lot of more important definition, market cycle, who are the key player for your knowledge. Next market, which is big in the financial area, is bond market. Okay, bond market. What's bond actually? Bond is actually, I would say, something many people may be familiar. It's like IOU. It could be from company, it could be from government. So in this case, debt security and issuer like U.S. Treasury market is the world's largest. And who issue it? Of course, U.S. Treasury issue it. Okay. And of course, Singapore have our own T-bill, right? And who issue it? Singapore government issue it, right? So of course, you also have credit rating on those people that issue this. So this credit rating, like Moody's, S&P, Fitch, play an important part on the bond rate they can charge or they can raise and all those things. So and the investor trust. Sometimes this agency also affects countries' borrowing costs partly through their rating and all stuff. So you heard about AAA or BBB or AA or A plus or whatever it is. Those are the rating they rate on, like the worthiness of the company or the country. Okay. So the other area is type of bond. Of course, we have government, we have corporate, and municipal. Municipal bond is mainly for public projects and all stuff. And each bond has different risk profile. So as an investor, you need to choose based on your goal and your risk appetite on what kind of bond you want to have. I mean, like today, I think there was an ST Engineering bond that's 4.2%, which is quite good, and people just launched today or something like that. So those are the things that if you are confident with the company, you can go into it, right? And market cycle, there is typically it follow yield curve, or yield typically rise on expansion and fall in recession. That means when the economy is on an expansion kind of path, typically the what they call it, the market will move upward, and the yield will move up too. Okay. What are the drivers? Are mainly the GDP. I'm going to let go of this and let me know whether you can hear me well or not, because I'm holding it like very uncomfortable. Okay. So like GDP growth, inflation, and interest rate will be the key driver they look at for the bond market. Okay. So again, this is like IOU, and of course, the biggest player who wrote this IOU to everyone is US Treasury. Right. Let's leave the question to later, or you can chat in here, and then if anything that you want to query, I will try to answer quickly. But as fast as possible, I will leave it to later on to answer. Okay. Next is the money market. So we cover stock market, and we cover the bond market. Now we are talking about the the money market. Money market also very important part of the financial market or financial players because they are the short-term debt like treasury bill, commercial paper, and CDs, and they provide the liquidity. Okay, as you can see, they are very low risk, short term, short maturity. So things like very quickly you can let go, and something like a smart park in Poem is also a money market that fund that we place in to get the return that you want, right? And the role of it is, of course, liquidity management. So easy to bring in and out. You can liquidate and pull it out. Um, Definitely, it's also used by many banks to borrow and sustain their daily operation. So daily funding needs and all things is quite easy to use. Okay, uh, but their rate is typically higher than demand deposit, but lower than long-term bonds. I mean, it's if you put in a very a short-term deposit with like our current account or our saving account deposit, our yield is typically quite low, sometimes 0 point something, 1 point something, but they are slightly higher than that, but lower than the longer term bond or even fixed D on some extent. But sometimes nowadays it's hard to say. Sometimes fixed D may not even yield as high, interestingly. Okay, market cycle expansion during economic market expansion, money market rate tends to rise. So where economy is good, is growing, the rate tends to go up. Okay, but again, when there is a recession coming in, tends to be that it will be lower. So that's why you see the central bank use this cut interest rate and stimulate economy, and that will also drive the money market rate because the short-term interest, the indicator is always demand deposit is more the US term kind of short-term, very like currency, current account kind of demand deposit kind of thing. So probably I should have changed the word here, but it's more like our saving account, and the demand deposit is very low. All right. Okay. What else? Let me see. What are the key indicators that may affect it? I mean, the short-term interest rate, which you can see from the market what they call it, interbank interest rate, inflation projection, bank reserve ratio. When you hear central bank reduce the bank reserve ratio, that means you flood the market with more money and all those things. Those are the factor. Those are the indicator that you can watch, which actually will give you the thing to decide whether the money market move in what direction. Okay. Next. Okay, derivative market. This is the more sophisticated. Some of you might have used it. Play option, futures, warrants, DLC, daily leverage certificates. These are different form of derivative market. Personally have played some of them, but I must say that usually it's a very good tool for what do you call it, level up your investment. But if you don't play correctly, it can also level up your risk. Okay, so I would say that's kind of the always every investment has both sides of the risk, right? So example is that this thing is futures and option. Futures is like a contract obligate buyer and seller to transact an asset at a price. So a lot of time it started in the agriculture area or even in a commodity area. When you dig out something or you grow something, you want to hedge against market volatility, you put a future that will sell at this price and all those things. So the future comes in. And it might not mean that you have to take up the commodity, but usually what they call that, a grower or a person who has physical commodity or agriculture actually uses this to hedge their risk. Okay, so that's kind of futures and options. Risk management and speculation, yeah, it's served for risk management because for a farm, if they're worried about next year, will they have a high uh, will they have continue to have good price for their wheat to sell, and I think they want to lock in a certain price or cotton. When I was in Nike, I worked with the treasury department, or I talked to the treasury department. They would tell me, oh yeah, the forward-looking treasury for cotton, Egypt cotton, they hedge it against on certain price and all that. Sometimes we hedge wrongly, and there were cases that we make losses on that. But it's to ensure that you buy because when you're a big player, you build a lot of things. You want to make sure that you don't want to have a risk that your cotton or your cocoa become too pricey, or no price when you cannot sell. So that's why futures is being used for that. Uh, uh, okay, there was a question about MFI. Can more funds stay in MFI means investors are not bullish with the market? Kind of, you can say that because because it's a short-term thing, right? People just put in there and there's little risk compared to putting in the stock market or putting in the bond market where you do not know what the direction and people can look. But bear in mind, money market fund also dip when there's a major crash. It doesn't mean that it is totally avoid, okay? But it definitely not likely to crash and stay there, but it may still dip when there's a major crash like 2008. Even some of our Singapore dollar, UOB Singapore dollar also dip during that period. So nothing is will avoid. Okay, but back to here, derivative market. Sorry, a bit of digress in here. It serves as a risk management. It offers opportunity for speculator to profit from price movement. One of the best I would say I can share myself. During the good BlackBerry time, I did play option on BlackBerry, and one day I can make 15,000-20,000 because you buy the right contract. It went up like crazy during earning. But again, those are opportunistic. So you have to be aware and be knowledgeable about it. And I must say, unless you're sophisticated, you can stomach the risk, okay, because you may lose everything too. So those are the things that you have to be careful when you play the derivative market. The market cycle and indicator, I would say it moved very relatively mirror the underlying asset management. So it also follow interest rate because there is option of future. They build in the cost of what they call it, the cost of money for the period of time they're willing to commit to the price that they're going to sell you. So the interest rate played a part into it. Okay, so that's and of course market sentiment. Market sentiment, like for example, during that time, I remember my time in Nike, there was one period the cotton, what do you call it? The yield was very good. I mean, there's a lot of cotton and a price war and all things, and becomes that the price went down. Although we hedge higher, that means we actually buying more expensive. So that's good and bad, I would say. There was another occasion when I was in another company within food, the cocoa price went very high. So the hedging was correct. So again, these are all the way financial market play with those area. It's a very good market when you use correctly. But again, you need to know how to play the risk. The next one is foreign exchange. Everyone know about US dollar, Sing dollar, Chinese yuan, Taiwanese dollar, Thai baht, Malaysia dollar. Currency. Every country build a product in the local currency and they trade to other country. And US dollar is like the kind of de facto trading currency. So currency trading is actually the biggest, the largest financial market, I would say. It facilitate currency trading. It also have investment purpose. Some people, like my case, my son is studying in Australia. I will look at the rate and I will buy some Australian dollar just to prepare for his student fund. So I mean that's kind of a bit of investment or a bit of ensuring that secure certain price for his fund in his study. So something sometimes for speculation, I did play. In the bank they always do this dual currency trading. So you hedge on certain currency, assuming that you would take up the currency if it hit a certain strike point or something. So those are the way that currency trading happening. So you can notice that it's a very big market. It's exceeding $7.5 trillion daily. So imagine the amount of money that move in the currency. Okay, high liquidity, almost like 24/7, I would say. And banks are the key player. They facilitate transaction, conducting proprietary trading. They also balance on supply and demand. Again, Treasury Department in corporate. I also deal with some of this because I was running an operation, and we sometimes because a lot of product is made in China, or Indonesia or Vietnam, but all the thing is done in US dollar. But we want to hedge our risk also. So we work out on how much currency we want to hold at certain place. So Singapore in Nike is a trading company, and their role is to hedge those things. So they decide how much of if we can pay in local currency, make in China, deliver to China, use China currency. I don't have to use another US dollar do the transition or transaction that have a forex risk or forex exchange differences. So those are the Treasury Department purposes. Their cycle again, usually a strong US economy, typically the US dollar will go up. Okay. Likewise, if the economy is good, their dollar will tend to stay up. In Singapore dollar actually is pretty strong compared to the other ASEAN country or Asia country. Key driver interest rate differential, trade balance, inflation, and growth rate. So how the country is growing or how it plays a part on some of these things. So that's kind of a quick view of these things. So I have kind of touched on the five key markets: stock market, the bond market, the derivative market, the foreign exchange market, and the money market. Okay, next I want to talk about the size of the market. Okay, global financial asset has actually grown quite a bit. And why is it so? Because in effect, we are in a debt economy. Debt economy means literally every country is printing money to fund their expansion. Okay, of course, US the biggest printer. Singapore also print a lot of money. That's why you can buy T-bill, and SSB and all things, right? Because it's a debt economy. The current world is a debt economy. You use debt to grow and all things. Okay. So global financial asset has already grown from 56 trillion to over 200 trillions. And this literally drive the value growth or the volume growth and all things. So this, beside the traditional bond, and stocks, actually the new equity debt market has grown into derivative, cryptocurrency, and then you see that Mr. Donald Trump, President Trump, even launched his own token, right, or his own currency on cryptocurrency. So see, the sophisticated player are actually leveraging this new way of growing their assets. Okay. They have regional distribution, although a lot of financial asset is concentrated in developed market like US and Europe, because they are the forefront of launching Dutch is the first trading company that have the, what do you call it, the Indian company. What's the name of it? I suddenly I cannot remember. But anyway, they have a trading company there. Then from there, they launched the first stock market and all thing, and then the financial assets start to grow from Europe and expand to US. Of course, now lately, China, India has also attracted the investment. The region has also grown in that area. Market cycle shape a lot of their financial assets. So when emerging markets surge or grow during expansion, a lot of the asset wealth will grow. There's this word I'm not sure whether many of you have heard about, called the US dollar tide. The tide of that means the tidal wave of US dollar. When they lower the currency, a flood of US dollar flood into the emerging market. And cheap loan, the people buy up the asset, push up the price, then it collapse the whole thing, then they take off the valuable asset and also. So sometimes nowadays, I think because of the what they call it, financial knowledge, as well as the social media communication speed and all things, people are more aware of the risk of US dollar types and all things. People are taking precaution and all stuff. In fact, 2 days ago, I think there was a news about the what they call it, ASEAN and RCEP meeting together in Milan, and there was some agreement on some of the financial facility or the what they call it, what they call it, borrowing ability or even digital currency. That the RCEP is working out on how do we help to grow ourselves better and protect ourselves better too. So it's interesting. The world is changing very fast. So knowing all these things is important. Again, key indicator is GDP growth, international trade volume, cross-border capital flow, and all things. Okay, I better watch my time. Stock market capitalization. I mentioned earlier on the overall size of the market. Okay, which I mentioned that is from 56 trillion to 200 trillion. But if you look at just stock market itself, Nasdaq plus NYSE is about 40 trillion. So there are other market, London, Tokyo, Shanghai, and everything. So all has all the different market and their capitalization. Stock market capitalization means you know, where when you have more IPO or when the value of the stock that is listed in there went up, capitalization went up. It depends on economic growth, corporate earning, interest rate, and investor sentiment. So if an investor is confident of the country or confident of the sector, it move up. Like the last year, I mean, AI is the hot story. You know, look at Nvidia move up like crazy, right? So that's kind of the impact of the capitalizations. Of course, with the recent DeepSeek rolling out and other AI ideas that came out, the story of AI in US is suffering a bit of the pullback of this area. So those are the things that you need to watch out on the news and all things. The market cycle and indicator, as mentioned, corporate earning, growth outlook, and all things, interest rate level and market sentiment all play a part. 2008 crash is because when the crash, the economic expansion slow down or stop, then definitely it will impact the whole stock market value and capitalization. Okay. Next, bond market. Bond is actually a very big market too. You saw that it's 40 trillion for stock market, but actually global bond market is $100 trillion. So it's not a small market. It's relatively big, and US Treasury is definitely the world largest. Definitely, that's why US Treasury use serve as a benchmark for a risk-free rate, affecting pricing across the global market. That's why I in my AMA or in the various sometimes I update about 10-year U, what's the direction? Is it bouncing up? Is it going down? Partly because it gives you an indication of what's the sentiment of the market itself. Okay, corporate and government bond. Corporate bond are primarily issued by their financial to raise money for their financial business operation and growth. Example I just mentioned today got ST Engineering, or even last time HyFlux, which is a bad story, but HyFlux was a case where they were over expanding and they couldn't service their loan, and of course it collapsed. So that's kind of the corporate bond risk out there. And US corporate bond is quite interesting too. Company like Apple, they issue bond for the R&D, but they also issue bond to have share buyback. Okay, and a lot of these companies actually use that to what they call it. You know, when you share buyback, your share outstanding share outside reduce. All right, outstanding share outside reduce means indirectly you push up the value, you can become more valuable. So for CEO, that is a good way if his remuneration is tied to the price of the stocks, and he has option exercise based on that. Why not? You use other people's money to buy back your own stock, and you push it up. So in fact, the US market, a lot of the company uses this technique to help meet their look good for their stock price and all that. Okay, the cycle again, expansion means bond yield will typically rise. The other way, it will go down. Key indicator, of course, is growth, GDP growth, company growth, inflation, and interest rate. Okay, that's kind of a picture of the bond market. Foreign exchange market, as I mentioned earlier, the biggest market, I would say foreign exchange market boasts about enormous trading at 7.5 trillion daily. So imagine to move the market, you will need a lot of money to move it. I used to know a friend whose mother is a forex player, stay in near Tanglin Road, those big bungalow. Then I realized why they are rich. Okay, they know how to play all these things. So those are the things that they are behind the scene. They are the old rich people that know how to handle this. Market center cycle, market dynamic, I would say economic data, geopolitical situation, Fed rate, emerging market changes, all these impact the forex exchange. So example, Myanmar situation, nobody would like to buy Myanmar, right? Myanmar situation will be bad, right? I mean, recent Pakistan and India situation will also create a bit of tension and concern about their currency too. So during economic expansion, forex trading activity tends to increase, but when there's a slowdown, of course, it will decrease. Rate differential, trade balance, and growth rate all play a part onto their forex exchange and everything. Okay. So I have covered only first part. Shit, better quickly. Key player in financial market. Now I will just run quickly on this area. The institutional investor is one of the top player. So who is an institutional investor? Like BlackRock, big guy, right? They are institutional investor. What they do, they are other institutional investor like mutual fund or pension fund, big funds, that insurer like AIA and Austin, they are institution player too. They scale their capital allocation to different area and they impact the market and all things. Okay. What are the strategy they employ? Sometimes value investing, sometimes growth investing, sometimes quantitative approach. Quantitative approach is more sophisticated about how the thing move up and down kind of things. Market cycle, very similar. Market volatility, interest rate level, economic data, all make an important indicator for their decision making. Okay. But most institutions tend to favor stock during expansion phase, that means growing phase, and bond in a downturn. So they buy bond to safeguard. Okay. Oops, I moved too fast. Investment bank, another key player. Their function and their service are basically facilitate capital raising through IPO or bond issue and all things. Investment bank, example are Morgan Stanley, JP Morgan, Credit Suisse, or Goldman Sachs, and all these are investment bank, and they give M&A advice, financial solution, and not cheap, of course. Investment bank adopt they uses different way to manage their risk and all things, but they also expand to like let's say for example, Ant Financial want to go IPO. Definitely a lot of people come after them and say, okay. Recently there was one good one, CATL, which is one of the battery maker in China. It's supposed to launch its IPO in Hong Kong. And I think the 23rd hour, US government stopped the US investment bank in supporting the IPO. So the pricing of the IPO was a bit affected because of that, because they pulled the handbrake. Again, it's more of a US China rivalry kind of thing. They pull it up, but that has an impact on that. Okay. There are key indicators on the market confidence of the company, and then they decide whether to go in or not to go in, the rates and economic data for the situation and all things. So that's kind of investment banks player, how they do. Market maker, okay, this is a little bit more difficult to, I would say more technical, I would say. Yeah, they are the player, they do the bid and ask. They provide the bid and ask to have the market liquidity by absorbing temporary imbalance. So, when you bid, somebody buy, bid and ask kind of thing. How come sometimes the bid and ask very narrow, sometimes it's wider? So the different player, they kind of to play to balance the supply and demand. This is called a market maker. And you ask who are the market maker? There are people like Citadel Securities, which dominate the market in market making industry, particularly in equity and option across US. Okay. Virtual Financial, also another leader in market making, but known for more sophisticated high frequency trading algorithm. It's not included here, but it's kind of verbally tell you about. So this thing called algorithm trading is more the sophisticated trading mechanism of high frequency trading. Okay. market also they also face market risks like significant price fluctuation or counterparty default when there's a liquidity risk. They also have that kind of risk. So nothing is totally buffered to them and all things. They also need to measure that risk. Again, during economic expansion, trading volume will go up, the widen the quota, the quote spread and all things. So on the contracting, it goes the other way. Okay. Uh, so I mean, so when quote spread widen means basically is in a recession, nobody want to buy, nobody want to sell. So the bid and ask become wider. Okay. Uh, Critical market indicator or critical indicator they look at is of course market volatility, trading volume, investor confidence kind of thing. Yeah, so you can say Lehman Brothers is one of those players in there. They were hit pretty hard when nobody want to support them during the 2008 GFC too. That's because the market mortgage-backed security was not doing well or was screwed during that time. Okay, hedge fund, another big player on this area. Um, uh, they are more sophisticated. They do long, short equity, event driven. They see an event, they drive those things up. The event could be election event. It could be a major launch of a certain new product or whatever it is. It could be an event that could also drive some of the hedge fund activity. They normally do a lot of quantitative approach on how to do it. Bridgewater Associates, one of the big one that Ray Dalio you probably heard of. They do quite a bit of distinctive macroeconomic analysis and investment strategy to manage all this. The risk and regulation, they usually are high risk, high return. Okay. The use of leverage to amplify their market volatility and systemic risk. So probably people who know how Ray Dalio runs his business sometimes. He will buy a lot. He would use leverage to buy a lot of low risk asset to bump up the gain. Of course, the high risk one he use other kind of instrument to hedge or to bid on the higher price opportunity and all that. The 2000 financial crisis definitely also demonstrated they also have their risks impacted. Many hedge funds suffer substantial losses because they overgear on certain area and all that. So again, market cycle and indicator very similar, increased exposure to equity when it's expansion, and so equity and risk asset they will go in, but of course on the other way they will hold back on those other. Again, the indicator is always market volatility, interest rate level, and economic data. So economic data is always one of those key areas that people look at whether are we growing. So when the global economy is not growing, of course everything will slow down, right? Okay, retail investor, that's where we are. Should be familiar with all, right? Because retail investor uses multiple assets like stock, bond, fund, and all things to hit their personal goal. So everyone have their own personal goal, what you want to arrive at. Some people uses SSB, uses T-bill, some people uses corporate bond, and I have a couple of friends who has a lot of corporate bond to get a passive income from there. Those are one way to ensure that they have always constantly have a passive income. But they also are speculative. They use go into stocks or go into even option to get a quick buy, quick gain and all things. So retail investor have participate in a way on those areas too. But the impact on the market, of course, we retail investor also boost market liquidity because there's a diversity in there. Okay. But however, we tend to have this fear of missing out tends to create bullwhip effect. Bullwhip effect means, we react and sometimes when you hit a bullwhip, you can see the up and down very, very high and all things. So that's why I call it bullwhip effect. We have a tendency to create that too. When everyone rush in, everyone rush in. When everyone rush out, everyone rush out. So there's a bullwhip effect on those areas. Okay, so the market cycle and indicator very similar with volatility, interest rate, and economic data. usually favoring growth stocks during a good expansion phase and then become slow down, like for example now or even during the COVID time, people start to buy more conservative product, like even a company that do consumer service that will not die and or insurance service, then they will make sure that they will not lose too much, or they will not gain much, but they will not lose in case there's an adjustment. Okay. So I covered two modules now. Structure of financial market. Looking at the time, we are about, I would say, another 20 minutes before I take a break. 15, 20 minutes, 15 there. This part, I will talk about structure of financial market, a couple of slides in here. There is always a primary market that facilitate new security insurance. These are people that investment bank, institutional investor, depending on the term through price negotiation. And there's a secondary market that usually retail investor play in. They are the market player like NYSE, Nasdaq trade allow the retail investor to trade the existing security. The primary market are the people like when you want to go IPO, you engage an investment banker and you say, hey, I want to issue my capital, and people assess your company. So I have a good friend who also launched his company in Hong Kong, and he was talking about why Hong Kong is so good, because you can walk to a building and the building is full of potential institutional investor that will buy your IPO. And there will be this investment banker just say, hey, you just go to this particular building, visit this ABCD company, and then see whether anyone want to take up the initial part of your shares and all things. So that's the primary market. Then secondary market is where we come in. We continue to the NYSE, Nasdaq, Hong Kong Stock Exchange, Taiwan Stock Exchange. All these stock exchange provide the venue for retail investor to go in. They also provide continuous liquidity and allow investor to enter and exit quickly. Okay. Again, market cycle affects issue and trading. When expansion, usually economic expansion, usually IPO is easy, secondary activity rise and everything. But when there's a recession, everyone just hide. It's typical cycle. So market confidence, interest rate level, and economy data again are those key factors that will drive the cycles, or will give you an indicator of the market situation. Okay. Now I go to what is organized and an unorganized market. So I know there's a lot of concept data I'm launching to you all, but an organized data or market is like NYSE, London Stock Exchange, Hong Kong Stock Exchange. These are big market. They are very organized. They provide transparency, fairness in trading. Of course, you want to launch an IPO down there, they also have policy on what can be done, what cannot be done, and all things. Like my friend was telling us, why Singapore SGX, when you do an IPO, the cost is may not be as high as Hong Kong, but the complexity or regulatory, and you still have to go and find your own funding versus Hong Kong Stock Exchange. So there's always benefit or different market offering different kind of suite of things. Like Taiwan Stock Exchange was another interesting one that we learned from another player that we were talking to, that the requirement is that you need to have prospectus in English and Chinese, and I think they only use the Chinese as a reference. The English is not being utilized. So Hong Kong is the similar, but I think it was Hong Kong. I can't remember which one. The one that Hong Kong have also both English and Chinese, but they can use. They are very careful on every word that they translate to. Okay, so these are organized market. Unorganized market, the over the counter. Sometimes you can see OTC. They are more informal trading or low transparency. For small firms, they want to raise money on emerging market security, but use OTC to launch. But again, it means less transparency, and also sometimes you want to sell, maybe you can't find buyer to sell, or when you buy, you couldn't find. Those are the challenge of those. Again, OTC is an avenue for emerging market security, but yeah, indicator of market confidence, interest rate level, economy data, similar thing that drive it. Okay. Market infrastructure, again, you have exchanges. I mentioned about Chicago Mercantile CME, which is actually the largest derivative exchange. You have different trading exchanges that help you to trade for security, commodity, and other finance. In fact, Singapore Stock Exchange also do some of the commodity and some of the exchange on options and all thing too. So there's also clearing settlement house. So they clear these are institutions like National Security Clearing Corporation or US and National Security Corporation Limited. In India also that take on trading risks and they help to clear the settlement and all stuff. Okay. Again, the activity normally rise during expansion and then falls during recession. Critical indicator again is market confidence, interest rate, and economic data. Those are the things that constantly been the main thing that drive some of these things. Regulatory body, again, there are regulatory body that manage them. Like, US, you have the SEC, SEC that control it. And of course, your UK, you have FCA, Singapore, maybe MAS or even SGX and all things that control some of the enforce the market rules to protect investor interests and everything. Likewise, they have global coordination because of to help address cross-border financial risk. So, as in our area of financial, there's always the anti-traffic, when they get money trafficking and all things that we need to avoid. So there's a lot of this global coordination in those areas and promote stability and sound development of worldwide financial market. They provide certain oversight strategies. So expansion again, they typically intensify monitoring on market transaction, especially like Singapore. When your stock values, stock price suddenly jump more than 5%, SGX may call on the owner and say, hey, what happened? Do you have something that's moving on? Interesting, in some other exchange, the Hong Kong Stock Exchange, they are very strict on IPO, but after that, they don't control that tightly. But again, China's stock exchange also have a cap or have a what they call that limit stock. That means the hot trading where it hit a certain 10% kind of thing. So there are different way they use to control the market transaction and all things. Again, market confidence, interest, and all things plays a part to it. So very quickly, I kind of run through this whole thing, and this is kind of my last slide on the third area, which give you an idea of the flow or the whole thing. What are the market cycle, what are indicator and all things. So the next one I will touch on is the market cycle and economic indicator. This one, I would say it's more on how the whole cycle move and all things. There's always 4 phases in the cycle. Okay. Number one is always about the accumulation, be it smart money coming in, buying up the thing. People start buying stock that's still at low value, and then they have an uptrend, and then distribution, and then of course the downtrend, the bearish market. Importance of market cycle, because you need to know where you are to whether you are doing accumulation or you should hold on the uptrend or you should sell now in the distribution phase. And some of the indicator, low volatility rates suggest accumulation. That means so VIX, volatility index, could be one way to look at it. Hey, if there's high volatility, people are concerned about it. And that means people want to get out of it quickly and all that. Okay, so that's kind of a market cycle. Leading indicator of some of this area of economy is like leading indicators like for example, in the stock market, you have the stock market performance, the yield curve dynamics, the consumer confidence indices. These are leading indicators. If people are confident, then the forward will be good. Consumer confidence there. The building permit is getting higher because it takes a while to build the thing, right? When you have higher building permit, means you are anticipating more building coming out on this area. I will answer the question later on there. So this kind of the building permit leading indicator. The lagging indicator is the unemployment rate because it already happens, right? Lagging indicator already happened. What's the inflation level now? It already happened. So it helps to confirm the economy trend, but it doesn't mean that the future is the same, but it does confirm certainty. Corporate profit is also another thing. Of course, another leading indicator may not be an indicator, but it could be a qualitative indicator. During the shareholder meeting, during the corporate earning announcement, sometimes the CEO or the CFO will give a bit of the outlook. What kind of product may be coming in. These are kind of a bit of a leading sign, but sometimes they want to mislead you too, so it's hard to say. Okay, again, these are just kind of giving an idea of what we are. Some of this is easy to find out. Some of this you may have to read between the lines. Okay, coincident indicator reflecting the real-time condition, helping investor to evaluate market cycle phases like GDP. Last GDP of US was negative because they have a lot of import and that affect them. So you must understand the devil is in the detail. Why is it negative? Is it because the export is less than the import? Why is the export less than import? Because they were trying to fight the tariff, so a lot import more than export. So those are the factors that will drive the GDP number and all things too. Of course, you look at the PMI on the industrial production, and also those also play a part to understand the retail sale PMI. Those are also indicators to give you an idea where the economy is doing. So market cycle leading indicator typically rise during expansion, but the coincident and the lagging indication also show positive momentum. So leading indicator will decline the other way around when is the other condition. So that's why a declining unemployment typically confirm economic recovery because more people have been employed. But rising unemployment means, hey, there's something wrong with it, right? Something to that effect. Rising inflation may also indicate that the economy may be overheating. So inverted yield curve or whatever it is could also give you an idea that, hey, is the cost of short-term borrowing and the long-term borrowing is offset, and is there in the US 10-year to 2-year, there's always a thing that if it's inverted means there may be a recession coming in. So those are the things that give you an idea of is there a problem there in that sense. Okay. Okay, there was a question. Give me a minute. Let me just kind of clear this thing first. Okay, there was a question about VIX. What value is considered to be at comfort level? Actually, the typical level is below 20 or even below 15. So at our current level, it's already on the higher side. Although it has come down from 50 or 40 or whatever it is. But you look at the past trend, usually it's less than 15 or even less than 12. Okay. It had been very low all the while, suddenly it started to spike up, and then it came down to 24, 23 recently, but it's still on the relatively mild side. I would say, wouldn't call it high side, mild side. So those are the indicator that people are still a bit nervous or cautious, the indicator. Okay, I'm going to move a bit of talking about Dalio economic and short term cycle and all things. I'm sure some of you have heard about Ray Dalio and his theory about economic life, short term and long term debt cycle kind of thing. Basically, what he mentioned is about our economy actually go in a certain wave and all thing. There's a small short-term debt cycle, which is the small cycle in here and all those things. And there's a big cycle of the country and all those things. And usually the small cycle will see a short-term recession and all those things, but the big one is the way you see a big decline in the economy or a depression kind of thing. And a lot of this is because of productivity. When the economy one good video you can watch to understand this is, of course, this link here. You can try and type it in and do it over there. Actually, I can copy over there. Never mind. Then, of course, the long-term debt cycle is where you see where are we in terms of the empire cycle or the country cycle. It's the overall slowdown of the whole thing. So within economy, there's always many small cycle here and there, and of course, then you have a big cycle. And I must say, why it happens is that there's always a credit and debit, or rather the borrowing and people willing to sell you. Because you want to grow the business, you borrow money to grow the business. But sometimes you overgrow yourself, then you couldn't pay the loan, then you created a cyclical kind of debt issue. So you have a short-term debt cycle within your own company, but then you become a bigger cycle in the country level. That's a big debt cycle kind of thing. Which phase of market are we at now? So that's a good question, which I did prepare a slide on the next one. So this is one of the things that I taught the other day. I talk about where are we at and all thing. Again, this is somebody posted this from the Ray Dalio talking about everyone is on a certain debt cycle. And if you read the book of the Ray Dalio, he will say that he even explained the Dutch Empire, the British Empire, the Chinese Empire in the past and all things. Everyone will go up and come down and all things, overprinting of money and all things. So, but actually US is quite kind of in this range of the debt bars and coming down, okay? China is also not doing very well, partly because I think they have their what they call it, provision debt, not provision, province debt that's quite high over there too. So that's something that we have to watch too. They also have the wealth gap. But the good thing is, of course, they are still moving upward. They are not on a downtrend, but they are still coming to the peak end. So it's like life cycle. There's a birth, there's a growth, there's a stabilization, and there's a decline. There's this cycle that's in there. And that's why recently, I think a bit, maybe one more minute of saying is that US dollar is reaching a point where we have quite a bit of interesting situation that's happening now. Let me see whether I have time now. Okay, maybe I just kind of give you all opportunity to talk this. I will jump into a few slides that I prepared. I was just talking about the different asset class. I mean, beyond money market and all these things, then there will have other market like real estate, cash, car, precious metal. I have not touched on cryptocurrency because I do have friends who work on cryptocurrency, but there's other markets. So I was talking about interest rate. You can see that typically it went up and then it start Asia financial crisis also have the similar thing, and then it start to crash down. And we are kind of at the stage where, the historical treasury yield 10-year to 2-year, there is also this inversion. And of course, this was January 2024 last year. But then, that's kind of the situation we were in last year, but it has completed its inversion. But usually inversion to actual recession, it can be 6 to 18 months. So we never know. So that's kind of the situation we are in. Early on, I'll talk about a lot of the indicator that we have. I think in the past AMA training, I did talk a lot of different indicators like non-farm payroll, core PCE. Those are indicators we use to see is the economy doing well or not. Okay. Things like Fed Watch. Example, this was I think this was a few months ago. I just kind of pulled the data out. I think that was the March number, so probably it's February sharing. I did divergent on price versus EPS. Those are data that you can use from stock market price. Is EPS growth versus the price growth? Is it there? Those are things that give you an idea whether the market overpriced for where it is now. This is one that added on the PE range between S&P 500 and Hang Seng, which is a market that's cheaper to invest versus the other one. I mean, during the peak, some of them actually hit very high, like US can hit 132. This scale is actually for the blue line US, and this green line, which if I'm not wrong blue line is Hang Seng. S&P 500 is the green one, sorry. So the green one is using the one outside, and this one is so it gives you an idea where are we on different market and all things. Is US in a bubble? A few months ago, I also shared this thing. So that's some of the things that we need to ask ourselves when when their relative price performance is at the high end side, internet bubble, even higher than internet bubble. Can this debt economy continue? We are in a debt economy, but can we continue this way? Okay. And this is one of the snapshot I pulled out from lately, a data that I extracted from a video call. They are showing an interesting trend where the treasury market debt. That means how much people are the buyer in the market from the foreigner and all things. So there is a big dip down there. It has a dip in the past and a dip now. So there's also some risk in there. That these are the indicators we use to understand. I think a few months ago or last month, I actually shared about when three markets, key indices, US key indices, the Nasdaq, the Dow Jones, and everything come down, and the US dollar also come down, and the US bond market also come down. When the yield went up, means the bond market come down. These are all situations that makes you nervous. Okay, so those are the things that you can look at. Okay, again, one of these slides that I have in the past is about fiat currency. We are living in a fiat currency, like it or not. In Chinese, it's a very good saying. It's called 货币. 有货才有币. That means, it's commodity money. It means you have a solid back commodity to back your currency. In the past, it's backed by gold. Now it's backed by economy size. And US economy size, how much confidence you have on that. So that's kind of the situation. Every country, fiat currency will go to zero. Okay, that's kind of a bit of that quick run through on some of the key economic indicator. I overrun a bit on the first half. But the good thing is I only have two more modules to run through later on the behavioral. So shall we take a 5 minutes break for now? Early on, we talked a bit on qualitative area of discussion, touch a little bit on quantitative, but not too much on it, just a bit of the market indication and all things. I'm going to talk about understanding risk and return now. This first slide is just a quick summary of typical risk and return kind of graph. Usually, a saving account is always the most least risk, I would say. Of course, the expected return is also the lowest. That's the typical of, there's a saying that you have low risk, then you have low return. But actually, it's the more correct way of saying you know your risk, because a lot of time high risk may not equal to high return. When you do not know the risk involved and you went into it, you only have the loss but didn't have the return. So important thing is to be financially knowledgeable in order to understand. Of course, if you start up and investment, crypto is always, the high risk, high return thing. I know of friends that is involved into, what do you call it? Angel investor or the tier 1, tier 2 kind of investor into pharmaceutical product and all those things. Those are a few hundred times they gain if they bet correctly. But of course, if you bet wrongly, I mean, there may be times that you lose quite a bit. I mean, they went into Grab. When Grab go IPO, they make it okay. So some of those, I'm not part of their league because they are different league. They are the big talky people, but knowing them is quite interesting to hear what their story is. But again, as you can see, cash is always on the low end. Of course, emerging market stock, high gain, high return, high loss too. So that's kind of the situation there. It's simplified the way of high risk, high return, but the more important thing I feel is more the fact that knowing your risk and how to manage it. Okay. Again, type of risk in investment, I would say there is many different type of risks. One of them is market risk. One of them is inflation. And you call it systemic and unsystemic. Okay, systemic risk, it's more like a macro environment factor that hit all investment and you cannot control it, or you have little tools to control it. Unsystemic is area where you can control, you could understand and decide whether to go in or not. Okay, that's kind of unsystemic. Okay, so like market inflation is something that you cannot control. Interest rate, government raise the interest rate. Can you control whether, hey, but government cannot raise the interest rate? You can't. Exchange rate, market volatility, country to country. There was a war, exchange rate change. All these things you cannot. A company went into reinvestment or certain other thing. There's also something that you couldn't control. So it's undiversifiable. Okay. What is unsystemic is like knowing the business. You can decide whether you want to go into that business or not. Country, which kind of country, which other business that you want to be involved in there. Liquidity of the company. You can look at the company P&L and all things to understand what's the situation. Marketability of the product and all things. Area of financial leverage. Okay. So those are the unsystemic risks that you can diversifiable. You can decide whether to even like financial or leverage. You can decide whether to loan or use option to buy more or sell more, or whatever it is to control your diversifiable risk kind of thing. Okay, so that's kind of a very simplified way of explaining type of risk in investment, the systemic and unsystemic kind of area. Because this is talking about risk of an investment. Then I'm going to move into when you look at investment, what are the metrics you use to look at investment in terms of risk or return? Okay, switching gear. So nominal rate of return means, what does it mean? Means the raw percentage of investment return, not accounting for inflation. That means you put in $100, you get $5 back as 5%. And that 5% don't account for inflation cost or whatever it is. That's called nominal rate of return. Okay. Again, it's a very simplified way of saying a bond yield of 5%. Investor will receive an annual interest income of 5%. However, this does not include the fact that your 5% at the end of the year you collected, the dollar value, does it become smaller? Because inflation means that your value of your dollar becomes smaller. So example, beginning of the year, you can buy a noodle for a cup, or maybe use a cup of coffee for 130. By the end of the year, the cup of coffee become 150. Indirectly, there's an inflation factor in there, right? The inflation factor in there is indirectly impacting your same $1 at the beginning of the year and the $1 at the end of the year is different. So your value has depreciated, even though you may still get a $5 at the end of the year. So that's kind of nominal rate of return. Then, of course, the real rate of return, again, that means what is the real rate you get when you adjusted for inflation or for adjusted for the inflation adjusted rate of return, okay? So example, earlier on I mentioned 5% and the inflation is 2%. So the real return is 3%. So that's kind of the simple way of doing it. Again, there's this thing called the statistical line. There's a white line, the true line, and the statistical line. Statistical line means that, sadly, in this world, the government or every agency, they decide what are the commodity or what are the thing they put in to calculate the CPI. Okay. Sometimes they may omit certain percentage or they adjust the percentage of the loading of a certain commodity to the overall CPI. So you may hear CPI is only 2.4%, but if you look at the detail, the CPI may have adjusted for maybe oil, maybe car, COE is not part of it, certain thing is not part of the inflation gauge now there. So you don't feel the real pain, or you don't see the real pain being calculated in the CPI. Okay, that's called statistical line. Okay, again, we are in this world. It's up to the world, up to the people to decide how we group and there's no perfect world of grouping, right? Even US, the same thing. They do adjust the CPI in terms of the percentage of for their. I think US, they even put in the rental. They put in the oil price or their petrol price or gasoline price. They have certain percentage. They keep adjusting. So a lot of time, we have to understand what is the true rate of return, real rate of return based on what is true inflation. Don't just listen to the media blindly. Okay. Of course, the other key area when you look at rate and return or risk and return is standard deviation. So imagine how much your investment return vary from its average return. Okay, so the volatility or total risk of an asset. Basically, interpretation is uh, it ties back to how much the fund, how much the variation of the pricing or the investment it will have. Typically, the higher the volatility means the more unpredictable is the return. The lower the volatility or the standard deviation or the sigma, we call it sigma, is a more stable investment. That means you have a narrow curve versus a wider curve. Okay. A stock with a standard deviation of 20% will actually means that it has a large return fluctuation. It can make 20% up, next time make 20% down. Remember the slide I showed early on? I think this, sorry, I just jumped a bit. This variation here, that's kind of standard deviation, right? If you have a very narrow standard deviation and a good return, that's something that you want to have. That means you can sleep more peacefully at night. Okay. Okay, sorry. Jump a bit back to here. Okay, so that's next one is beta. Okay, beta ratio. Beta is a ratio that defines the sensitivity of the investment return to the market fluctuation. So a value of greater than 1 typically indicate higher sensitivity to market volatility. Okay, so application typically a beta of 1.5 tends to deliver higher return when the market rises, but also incur greater losses during the market decline. So when you look at fund performance or people want to sell you a certain fund, then you can ask them what's the beta of this particular fund over the last 10 years, whatever it is. So it helps to gauge you how this particular investment in terms of its performance, its sensitivity, investment return to its market fluctuation. Okay, less than 1.0 is less volatile. Example, tech stock usually is more than 1. Utility stock is less than 1. Move inversely to the market, gold in crisis. So when everything dropped, gold went up. So lately, I think you can see that the gold has actually become like a safe haven. And there was a blogger that I follow through, and he keep insisting that, guys, we are in the stage of what they call it, more uncertainty. You should always put aside some money into physical gold, not paper gold, because paper gold, one thing very interesting is I also read another article and understand that, do you know the GLD paper gold? The money, what they call it, the amount of value of that GLD versus the asset that backing it is 60 times difference. So that means you have $1 is selling at 60 times more in terms of liquidity and all those things. So if there is a rush for the money, for the gold, you want to, let's say you have 100,000 of GLD and say, I want to convert to actual physical gold, you may not even have it because there is not enough to convert it to. And there was a clause within GLD too, that unless you are an owner that is, if I'm not wrong, was $200,000 per investment, then you have the right to convert. So those are the fine line that you need to read and understand. Okay, a bit of deviation. That's kind of beta, knowing your risk investment return to the market's fluctuation. Another key measure is called Sharpe. Sharpe is an indicator assessing risk-adjusted return. Okay, it calculates the assessed return of an investment over the risk-free rate. Okay, so again, because it's sophisticated RP minus RF and all of divided by the standard deviation and all. When you look at a report and ask them for a Sharpe, it gives you an idea of if a ratio of 1.5 indicates a superior risk-adjusted performance relative to a fund with 1.0. Anything bigger, tends to be, it perform better than the other fund or the other thing from a risk-adjusted performance perspective. Okay, you can actually take a look at these leads to understand further about it. But today I kind of give you a lot of concept and idea on what exactly is. A summary of some of these key ratio for your knowledge is that standard deviation calculate what is the volatility of the return. It measures the overall risk and uncertainty. Okay, higher the more volatile, lower the less. Okay, but beta measure the sensitivity to market movement, systematic risk. Okay, so more volatile than market or less volatile than market. Okay. Alpha, I didn't cover alpha. Alpha is another one I just decided to put it in here. Alpha usually measures the manager performance, skills of the manager. So sometimes you can look at alpha 2, excess return versus a benchmark, show manager skills and performance over there. But I mentioned about Sharpe, right? Sharpe is risk-adjusted return. Evaluate the return per unit of risk that you're involved in. Higher, better, for risk-adjusted performance. So hopefully these are the few key ones from a risk return perspective, give you an idea how to look at it. The next slide, I will kind of give you an idea of, every investment we get involved in, there's always a kind of balancing. What are you putting in yourself in the risk area? What are risk metrics you look at? And what are the financial return you look at? So you need to look at the type and the time duration you are looking into it. The return in terms of yield and loss of the investment on other opportunity and all things. So those are the things that you can consider in order to look at their type yield and loss of investment. So the timing is very important because how long do we have the time to wait for the returns? Give you an idea. Which I actually put in about Warren Buffett, one of the video in Chinese over here that I put out here. I just saw it a few days ago. Quite interesting is that, do you know that Warren Buffett, he bought a company called Sea Candies, which is, he bought it at much higher price than what he would have bought it based on his secret but investment theory on. He always buy a cheap price one. But his partner, what's his partner called? The one who passed on already, they actually convinced him to buy Sea Candies. So he bought at a higher price, but you see what's his partner name? Suddenly I cannot remember, sorry. But he see the value in there on the free cash flow that can cover his return and can use the return or cash flow to buy other investment. And he made, Charlie no longer. Thank you. Suddenly I forgot. Thank you, Ray. Thank you, Richard. So don't assume high price mean is not right to go in. Actually, you need to understand. So the next module, I will talk about fundamental analysis and cover more of those areas. But again, I want to call out this thing is because he hold the Sea Candy for many, many years. He bought another very famous company, everyone knows about it, called BYD. BYD, he bought about 9 Hong Kong dollar or 8 Hong Kong dollar, I can't remember exactly. But he hold for 14 plus years. And now you know the BYD is in the 300 to 400 range, 380 or something like that. So it's not immediately you make the return, but you hold through the whole period. So understanding what is a good company, what's their economic mood, what is their free cash flow, what's the margin and all that. Understanding the risk profile, understanding what is their beta of Sharpe or what do you call it, standard deviation, helps you to make a good decision on the risk return trade-off. And you yourself need to know how much of this money are able to put inside that. You cannot put your daily expenses money into investment. So those are the things that you need to do a risk return trade-off in order to be successful in financial investment. Another area is called dollar cost averaging. Because we never know when to time the market, right? Very hard to time the market. So dollar cost averaging is another way to help manage your risk return by leveling the timing of the market and all things. And so another purpose of this is also when you are a small investor, you may not have one big lump sum to go in and jump at the right time and all things. But you know a certain market is the right thing to in for the next 10 years. Let's say 5 years ago, if everyone have a foresight that AI is coming up, and everyone see that NVIDIA is the GPU is coming up very fast, and you continue to invest $100 of NVIDIA for the last 5 years, I think you make a lot of money out there too, right? So dollar cost averaging is another method to help you to manage your risk and return over here. So that's kind of the module 5 talk about risk and return. Now we're going to talk a bit more on the emotional bias part of it, interesting area about emotional part of investment, which is, I think, is my weakest part of my whole thing. I can do a lot of analysis and all things. Sometimes I do make a mistake on the emotional part, and I'm sure many people have a lot of different story about their own area. So let me talk about psychology of market cycle. Just now we talked about accumulation, uptrend, distribution, and downtrend, right? I mean, this is a very interesting chart that I managed to pull it out, and then top phase. Quietly people are accumulating the money, smart money coming in. They accumulate the thing before it start to take off. Later I comment on your question, okay? So they slowly accumulate until news start to pick up and people start to be aware and it start to go up, okay? And there may be a bear trap sometime coming down a bit and then it start to pick up again. So then there's this mini-up phase and it just jump like crazy. And guess what? Like AI last year, our NVIDIA or even Tesla many years ago, they had this mini-up phase. It just went crazy, right? People just go in and buy and continue to push it up higher and higher and higher and higher. And then suddenly, oh shit, denial now, it came down. So these are 4 phases that happens. And sometimes it always occur in our fear and greed kind of thing, this phase is always about greed. People just chase after it. It can be better. Next quarter, the result will be even better and all things. When they start to turn down, people say, oh shit, I already hold so much of this. No, I think it will return, it will bounce back and all these things. Sometimes denial and continue hold. A smart investor use 10% cut loss and they may cut it off and move on. Or they have a target price, they cut it off and move on already. But most of us are emotional. Sometimes we did not let go and we hold on to it for too long and it hurts us. I guess one of some of my biggest losses are mainly stock that I've hold on too long when it never return. Okay, so those are the sad story, but it is the true phase. Smart people, they always slowly accumulate. And by the time it's so high, they already run off already. Okay? So let's talk about some of the behavior, emotion that we need to be aware of. First of all, is loss aversion. Okay, this is one of the most common behavior of many retail investor. Our fear and greed plays a major part to it. Past experience also, because usually we experience more pain from losses than pleasure. Okay, when you lose, you feel so painful. Versus you gain, wow, shook, man, or things of that nature. So we may prematurely sell winning asset to lock in gain, or we hold on to a losing asset because it's so painful to lose. So you hold on to it and you hold on to avoid realizing the loss. But in the end, you lost more. Okay. Many impact like miss the market rebound opportunity. Most recently, let's say April. Unfortunately, I was on vacation, so I kind of hit myself because I wasn't able to trade when I was in China. So I was like, oh shit, I could have missed a lot. I was also busy traveling, so I didn't got a chance to scoop some opportunity when it's down because you're in there traveling, you're busy. But those are the missed opportunity when rebound come in. I think I did post in my Discord that hey, VIX has dropped down. VIX had dropped down from 40, 50. The greed indicator, greed and fear indicator had gone to 5 and 4, and then go up to 10. Maybe it's time to go in, things like that. But I myself was also unfortunately on travel. I couldn't do that. So case study also shows that 2008 financial crisis, many of them hold on to their declining stock and only incur greater losses. So sometimes We need to understand ourselves and need to know when to cut off. Sorry, running out of voice. Okay, next one is overconfidence. This is also quite common in many retailer. He think he knows the market, and a lot of time, one of the biggest losses. I'm willing to share some of my painful thing. I was making money on one particular China stocks. I sold it and I captured a profit. Very happy. And a friend say, "Hey, the OCBC broker and me knows, and then we know the CEO is going to launch. This is going to be the price even higher." Went in again. In the end, it didn't go up. It went down. By the time I want to cut loss, the stock went to what they call it, suspension. And in the end, I have to lose everything in there. So it's a bit of stupidity because of the greed that you went in again, thinking that you have the insider info. So very careful. Insider info sometimes is to lead you into the hell, not lead you into profit. So actually my partner or my friend who told me this news, he lost few 100,000. Although I lose tens of thousands, but compared to him, I think relatively smaller. But this again, excessive confidence on certain thing has an impact. Another thing is also when it's too confident, you only put in one particular stock. That's also very high risk, concentration risk. Okay. Uh, uh, Forgot to turn on camera. Thanks. Yeah, never mind. My wife was walking past, so I turned off the camera for a while. Okay. Increased investment risk and can lead to significant loss. Yeah, like cases like 2020 cryptocurrency boom, many overconfident investors pour too much into it and lost quite a lot. But of course, recently with Trump trying to push currency, crypto, it went up again. So again, overconfidence, or rather the thing rebounded. Herding bias. This is very interesting too. We human is a bit of a social animal, okay? So we tend to blindly following others. Hey, the person is expert, he's right, so I should be okay, right? So let's chase the market trend. You know, then when panic selling, everyone sell, you also sell. So market downturn, everything like that. So that's kind of the uniqueness of human nature. Knowing your human nature is critical to help you avoid all these mistakes in such kind of situation in there. The past.com bubble, the virtual reality. Remember, there was Facebook changed its name to call Meta, because they want to do Meta, right? So there was a huge hype about Meta. And then after that, everything cooled down. I think the China or Hong Kong also have a lot of virtual reality stock also now turned into nothing. So there's a hype on it. Now, of course, the AI hype, right? Example that we tend to push up valuation when people are hyping up on it. Okay, and beyond the reasonable sense on their valuation. So I think that's where knowing a fundamental analysis become a play. I always like this picture, where people all the herd of sheep just move off to the cliff, and somebody say, "Hey, wait a minute, something will feel wrong." Then people say, "Shut up, you moron, do it as what you have been told. If you Is for your own good." Now people tell you that. How many of them are critical thinker, are confident enough to say, "Hey, something is wrong. I don't want to follow the queue." I know of this particular investor. I mentioned about one that I lost money, right? So he has one very good friend, which we always call him Lao Da. And he's the only one who never follow him. And he make the money. See, herding biases versus non-herding biases. So something I learned from there too. Anchoring effect, there's the another one. I call it we are creature of memory. So, we have memory of certain thing. Hey, this is bought at this price. Last time it hits this price. So it will hit back the price again. Sometimes we have this anchoring effect. So investor resist adjusting their strategy even when market conditions have changed. Okay. We anchor to a certain peak value we think it will hit again, even though the situation has changed. So the anchoring effect does impact us too. Okay. So that's something that we need to realize. This is our behavioral kind of a biasness that we may have. And not everyone have, but some of you have some of this, right? So next is regret and disgust. Sometimes I do feel that too. I have a few couple of stock. I decided to just keep it down there and just use it as a reminder of me making the stupid mistakes. Okay. But that's not a regret. Why did I sell it? I see the thing coming. Sometimes knowing too much is good and bad. Good in the sense that you can predict and you can take action. Bad in the sense that you think you can outsmart the market. Okay. And then in the end, market changed very quickly and then you got hit. Okay. So those are the things that regret and disgust tend to be causes to be overly cautious and indecisive. It regret on aversion, and some people fail to capitalize on market rebound, like most recently in the market rebound. How many people went in when it down, right? And when it great dropped to 4, 5 and bounce up to 8, 10. I cannot tell people that go in now, but I just say, hey, it start to move up, maybe you can consider. But nobody will know exactly, right? But you can buy in incremental. So those are the things that I would say. So very common, even seasonal investor also have this mistake sometimes that our greed or our thing can cause us our mistakes here. So I would say this emotional bias affects our investment decision overall. Fear could be missing maximum profit or sell too early and went in higher above fair price. Sometimes fear also means that we don't even go in when the price is down because we fear that it will go further down, right? Greed is when you're buying more, and then we want to buying more when the price is coming out to average down, or we buy more when it continue to go up and there's a risk of collapsing. Okay, those are possibility. I mean, I use those words kind of fear and greed in the sense that in this chart it did give you an indication that that this when it's up, you always feel good about the investment. When it came down, you have a denial. Temporary setback. Never mind, we just hold on. Then when it came down too much, you panic. Make the market. Maybe the market will just adjust or just for me. You start blaming yourself, start regretting and all. But if you have a strategy to cut loss and all things, you probably won't land up to that kind of situation. So that's kind of the area that we need to learn how to build in certain means to help us reduce the mistake that we could do, okay, on the emotional bias. So that's kind of overall idea of what are the key emotional bias. It may not be overall, but at least give you an idea of what is it. And what are strategy for overcoming the emotional bias? One of them is very easy. Set a very clear goal and time horizon, okay? When you go into the investment, why you want to go in? Is it for speculative? Is it for short term, for long term? Is it for knowing this market is growing at a certain pace and you want to do it? What was your purpose? Have a very clear whether short or long term perspective and you mitigate the short term emotional fluctuation. So when you go in, you have a very clear idea of why you want to do that. And for my case, I personally will do a bit of my PE, fundamental analysis, technical analysis, decide if this is good or not, and I even put a journal on that and go in or not. There was one period I even cut myself. I have too many because sometimes you have told that there was famous word from my ex Nike CEO. We all have finite resources, but infinite opportunity. So we have finite resources in terms of financial resources or time or money or whatever it is, but there may be infinite opportunity. So we need to be strategic and tactical on how we invest, how we put our resources to work, because there's so many opportunity. You can't put everything in there. And in the case for myself, I would say sometimes I like this stock, I like this stock, I like this stock. Then I realize, oh shit, I got 20 different stocks. Then it becomes very hard to manage. So I try to start to trim down and say, okay, let's narrow down to 5 only. 5 for a certain sector or 5 for a certain market kind of thing, so that you control your breath and you stay focused on certain objective and all things. Um, so you need to understand your goal and time horizon. The other one is that diversify your portfolio. You know, diversify investment across multiple assets helps to reduce the concentration risk. Okay, the impact of volatility on one single asset that may hit you. So let's say I only believe in Alibaba. I buy 100% on Alibaba. If Alibaba got a bad news on the market, everything goes down. You lose everything, right? So why don't we have different segment or the same competitor, but maybe a different Jingdong, Alibaba, or Amazon and eBay, or Microsoft and Google, something to that effect to balance some of the risk and all things. You may 40-60 split or whatever it is. So diversified portfolio. Of course, you can even diversify in terms of different asset class and all things. So like global equities, bond, real estate fund, and investor reduce the single market risk, concentration risk out here. Next is self-awareness, emotional engagement and management. That we touch on it on emotional bias and all those things. The purpose is to how to maintain your composure when you go to investment. Don't hear, wow, suddenly this thing spiked 20% now. I want to jump in already. Example, yeah, the recent news now, the Pakistan and the India conflict, right? Was this particular plane manufacturer of China, Chengfei, if I'm not wrong, Chengdu Feihang 公司. It was listed in China Stock Exchange. It jumped 20%. So do you chase after it? People will say, wow, okay, this is going to be a good news because their weapon is good and all things. People jump into it. So this is where you need to maintain a composure. You need to be emotionally managing it. I feel that, and this is some area that I do investment journal, but sometimes habits takes a long time to build in, and it also takes a lot of discipline. Sometimes when you're traveling, you don't follow through. You just feel your gut feeling instinct. That's always the risky part of it. Documenting the emotional contact also helps. So I do have reflection, and I do reflection to help me to understand, hey, where's the mistake? How do I adjust my strategy and all things? Those are the way every one of you will need to find your own way of investment technique. Okay. And then this is just give you an idea of some of the behavioral symptoms when you have panic attack. Fear of dying, racing heartbeat, boom, 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 boom. Then you use deep breathing, find a focus object, take a walk. For me, sometimes to make a major decision, I always like to walk the green or walk in the area that have some fun peace and help me to calm down myself to make a decision and all thing. I just saw a blogger who shared a story about before he want to buy a stock or whatever, he feel his center of the palm is chilling or is it warm. When it's warm, it means my energy level is good. Probably it's a good time to buy, or it's a good time to invest, or it's a good time to consider the investment, whether it's sell or buy, right? But when it's chilling, means maybe your body is telling you that you are reacting on the behavior symptoms and not really in a positive energy manner. Just sharing some of the thought process somebody shared. I like sharing because when you share, you help others, but you also hopefully that people share with you, you also gain from there. So never feel to share. Okay, the other one is of course leverage professional advice. Again here, I would cautious is why you use professional advice, because you want to have objective expert investment advice. Okay, and then it will help you to avoid emotional bias. However, you also need to choose your advisor with the knowledge that you need and willing to understand you as your need and all things. Because a lot of time, some advisor or some RM, like say example bank RM, they have a target to hit. They just want to sell the product to you. One of my good friend is also narrating his story about scolding the RM who was trying to sell him a high flux or municipal bond. Then he was telling him, do you know what is the return of this thing? Do you know what's the risk of this thing? And he actually gave him an education there. You are actually risking other people by giving the wrong advice to sell certain thing. So those are the things where we hope to gain our financial knowledge, not to just blindly listen to people's advice, but also have intellectual to understand whatever advice given, is it make sense or not? Okay, of course, the advisor also help you to regularly communicate and adjust your portfolio and the market dynamics. So that will also help you to, sometimes we are all busy, especially when I was in corporate life. I still have a UK advisor around, not UK, now he's based in Malaysia, but it's a UK fund. Every 3 months, he'll call me and say, hey, this portfolio, what do you think, And sometimes he told me certain thing, I will throw him back. I don't think this is the right thing. I want to adjust it differently. So your knowledge also play a part, but you also bounce it back. It's a bouncing thing to learn from each other. Regular review and adjustment, that's the other area. You continue to review, to adjust, to make sure that your strategy, your long-term goal is being aligned. Okay. So you evaluate a portfolio hopefully every quarterly or annually or semi-annually to see whether it's aligned to your long-term goal. Well, many of us are very busy, and I must say, we have to take our own initiative. Besides, also the advisor also take the initiative to reach out to you. Sometimes it's also good. Hey, you hear some news on the market, then maybe you can call them out. Hey, I saw the news. There's the $6.5 trillion of debt that US need to refinance within the next 4 weeks to 6 weeks. You see a risk on our current portfolio. I mean, that could be the case that you need to study on those areas, which is truly now the current situation. The next 4 to 6 weeks, there are some huge 6.5 trillion of debt that is being refinanced, and the amount of debt that can be sold to the market, and the likely yield will also affect the market itself. Okay, so those are the things that regular review and adjustment will help you. So in a way, I would say the strategy for overcoming your emotional bias is set clear investment goal, diversify your portfolio, focus on your long-term or your short-term or your mid-term goal, wherever it is. Short-term usually not so, I mean, even short-term, you need to be careful in the sense that you need to be disciplined to cut it off. Okay, I have some short-term option there. I get carried away and didn't focus, and I lose money on that too. So sometimes discipline is the key word to you. And of course, conduct your own research. I guess this is one of my last slide, and of course, there's a lot of this link that below. You guys can look at it. Thank you for the time. We are 9:56 p.m. Well, 5 minutes before the end. Any question, guys? You want me to elect? Oh yeah, there was one question about, can you comment on the current S&P 500 PR relative to some Mag 7? What is PR? PR means, sorry, what is PR? PE, you mean? P relative to the Mag 7 P. I think I have a slide on that, but I can't remember. What's P level? This is price, this EPS, or I may not have included in here. To be honest, I didn't include in here, but Magnificent 7 PE has dropped over the April because of the big dip. It has dropped to a more reasonable level, but it's still high relative to, if you look at the PE range for S&P 500 versus Hang Seng, it's a lot higher. However, because it's more liquid in the market and all, things, people tend to still go after it. My personal advice or my personal preference, I would still want to be more cautious, partly because if I look at the US economy, the tariff that's happening now, we are still seeing good payroll. We are still seeing good PMI for service industry. Because the tariff impact or the higher consumer price has not hit them, because it takes about probably about easily 4 to 8 weeks, because you have inventory to clear out and a new inventory coming in before it hit the market. So likely in late May or June, July, then the market will see whether the CPI, I think the latest Fed report yesterday, if I remember correctly, did mention that they are predicting or they are projecting a 4% CPI. Interesting detail that they mentioned on that in the next coming few months, if I'm not wrong. So that's a CPI impact on that. Would that impact the consumer ability to consume? Because don't forget, US is a 75% GDP driven by their own consumption. Okay, Magnificent Seven, though, is more tech company and their global exposure has less impact on that. But a slowdown in global economy due to the tariff will impact them too. So is the current lowered PE still good enough? I would say I will stay cautious to watch on it because why rush into it when you know that now you have the tariff issue, you have the debt refinancing. Why don't I just wait and see before I jump into it? That will be my take. Okay. Any other question? Whether there's another slide in there that has. So this is the one that I mentioned about some of the debt that is kind of a bit of scary. The treasury market debt. Not many people or the if US cannot continue to raise their debt to grow their business. I mean, Trump is trying to use tariff as a tool to get people to bow down to him and appreciate their currency, so make US dollar cheaper, so they can export more or make people come to them to manufacture the product. I think he's a very strong strategic or smart guy, but his way of doing things is too harsh, and things are affecting it.